Lesson 2.6 will deal with different types of investment funds. We will deal with 3 types of investment funds, talk about how investment funds work in a general manner, and then we will deal more specifically with one of the types of investment funds called an open-end fund or a mutual fund. And we'll talk a little bit about the different types of mutual funds that are available, some of the calculations that you can do with regard to the value of a mutual fund and the rate of return on a mutual fund. So Lesson 2.6 will provide you a general overview of investment funds in general, and then a more specific view of open-end funds or mutual funds. The first thing that we'll look at is how an investment fund works. Any of the 3 types of investment funds that we're going to be talking about work in this manner. Investment funds are considered financial intermediaries because they collect money from several investors, they pool that money, and then they invest in specific investments to be held within the fund. So they are bringing together the investors and the investments. So they are intermediaries in this way. The collection of the funds and the pooling of the assets, that just refers to each investor in the mutual fund provides money to the fund. All of that money is pooled together, and investments that meet the criteria of the investment fund are then purchased. And every person who has provided money to that fund owns a percentage of the fund as a whole. They own little pieces of everything that has been invested in. The 3 types of investment funds that we will deal with in this lesson are called unit investment trusts, closed-end funds, and open-end funds. And we will deal with unit investment trust and closed-end funds in just a general manner, and then we will go into more detail on the open-end or mutual fund type of investment. With a unit investment trust, the first thing that we note is that the investment is unmanaged. That means that once the investments are purchased, they are held as is until the maturity date of the fund. There's no active management or buying and selling of investments within this fund. So the fund is established, the investments are purchased with the money that has been provided by investors, and it is held that way until maturity. There are a fixed number of shares to a unit investment trust and a maturity date. So once the purchaser has purchased units of the investment trust, they hold a certain percentage of that trust, and that doesn't change because those are the only shares of the fund that will ever be sold. They hold those units or shares of that investment trust until the maturity date, and then at the maturity date they will receive their proportion of the total value of the fund at maturity. If, however, the investor does not want to hold their units or their shares until the end of the maturity date, they can sell them back to the fund and redeem those units at the value that they hold at that time. So you're not locked into the investment of a unit investment trust. You can get out of it if you like to. You just have to sell the units back to the fund. Now, a closed-end investment fund is similar to a unit investment trust in some ways and different in other ways. It's similar because it too has a fixed number of shares and a maturity date. So again, when you purchase your shares of the closed-end investment fund, if you've got 10% of the total shares outstanding, that won't change because the number of shares is fixed. And you hold those shares until the investment fund matures and you receive your proportion of the total value at maturity. The difference is, however, in the other 2 points on the slide. The first one is that instead of being unmanaged, the closed-end investment fund is managed. And that means that there's a fund manager who is trying to increase the return on this fund throughout the time period until maturity. And they will buy and sell securities as they see fit to accomplish that objective. And then finally, with regard to the way that an investor can get out of the fund early, they can hold it until maturity, but if they choose not to, in this case, instead of redeeming it back to the fund as you do with a unit investment trust, the shareholder must sell their shares of the closed-end investment fund on the secondary market. So if I want to get out of my closed-end investment fund before the maturity date, I have to sell my shares in the investment fund just the same way that I would sell shares in stock to another investor on the secondary market. And then finally we'll deal with the open-end investment fund, which is another name for a mutual fund. And we'll go into quite a bit more detail on how a mutual fund operates. But essentially, a mutual fund is also a managed fund. There are some types of mutual funds where there is less management than others, but in general it is a managed fund, so the fund manager is trying to increase the return on the fund by buying and selling. We say that an open-end fund or a mutual fund is in a state of continuous distribution, and this is how it is different from both the unit investment trust and the closed-end fund, because there's not a stated number or a set number of shares of this type of investment. Every time someone wants to purchase more units of a mutual fund, they can do so to the mutual fund. So the mutual fund is continuously issuing new units of that fund, and they also are redeeming any units of people who don't want to hold the fund anymore. So you redeem your units to the fund, and people can continuously buy into the fund. So they're continuously distributing and redeeming units. The other difference between the open-end fund and the closed-end and the unit investment trust is that an open-end fund has no maturity date. You simply purchase the units in the fund and you hold them for as long as you want to hold them, and at such time that you don't want to hold them anymore, you redeem them back to the fund, and they will provide you with the value of your investment. Investment funds are very popular types of investments with investors throughout the world. There are many reasons as to why these types of investments are popular, and we've listed 4 of them here for you. When we look at the benefits of investment funds, we're looking at the benefit to investing in an investment fund versus buying individual stocks and bonds and having a portfolio that way rather than a portfolio of mutual funds. So that's what we're dealing with the benefits here. So with an investment fund, record keeping and administration is one of the benefits, where if I own a mutual fund, they will send me quarterly reports that will tell me what my asset allocation is between the 3 investment classes within my funds. They will tell me how much foreign holding I have as opposed to domestic, and they'll provide a record of my average cost per unit and my what we call the adjusted cost base, what I've paid for my units for tax purposes. So that record keeping is done for you with a mutual fund, and with individual investments you'll get statements from your broker, but it's a little more difficult to get all that information. You kind of have to do that for yourself. The other difference with regard to the record keeping and administration of a mutual fund is that with mutual funds you always have the option of reinvesting your dividends. Mutual funds pay distributions throughout the year, sometimes monthly, sometimes once a year, sometimes semi-annually, depends on the fund. But when they pay those out, you can receive them in cash if you want, or you can have it set up so that that money will just be reinvested in more units of the fund. This option is available with individual stocks in some companies as well, a dividend reinvestment plan. When dividends are paid on the stock, they are reinvested in new shares of the company. But it's not available with all shares. With investment funds it is. The second benefit of investment funds over individual investments is termed diversification and divisibility. And this refers to 2 different things. First, I'll deal with the diversification. When I buy 1 unit of an investment fund, I am buying a piece of every investment that investment fund owns. So the investment fund probably owns 20 or 30 different types of stocks or bonds, or a combination of both depending on the type of fund, and I'm owning a piece of each one of those. Diversification happens, essentially what diversification is not putting all of your eggs in one basket. So if I had 100% of my money invested in one company and that company's value declined, then my whole portfolio declines. Whereas if I have my money invested in 10 companies and one of them goes down in value, well, the other 9 at least aren't affected, so I'm reducing my overall risk. With an investment fund, that's easy to do because the diversification is already done for you within the fund. If I buy individual investments, on the other hand, I have to buy some of 20 or 30 different stocks in order to have that diversification, and that's going to be very costly for me to do, whereas with mutual funds it's easy and it's affordable. The other difference here is in divisibility. And what that refers to is if I'm buying individual shares, I can't buy half a share. I have to buy 1 share or 2 or 10 or 100. With investment funds, again, when I purchase my unit of the investment fund, I own a piece of everything that fund owns. So I own fractions of shares. It's available to me with an investment fund where it isn't with individual securities. The third is professional management, the third benefit. And what that refers to is that with an investment fund, the investor knows that there is a fund manager whose job it is to manage this fund and to make decisions on what types of securities should be held and for how long and when they should sell them. When you have your own investment portfolio, you have to make those decisions for yourself. So you have professional management as opposed to making those decisions on your own. And then finally, with regard to investment funds, you have lower transaction costs involved than you do with buying and selling securities on your own, because the investment fund can pool all of the transactions and can get better rates on their trades than what you can get on your trade buying or selling 100 shares of a particular company. With open-end investment funds, we say that you buy a unit of an open-end investment fund, and the price that you pay for that is called the net asset value per share, NAVPS. And essentially what it is the net assets of the entire fund on a per share basis. So all we do is we take the market value of the assets, subtract off the market or the value of any liabilities that the investment fund has, and then divide it by the number of shares outstanding. And that gives us the value each day of that particular fund. And net asset value per share is generally calculated on a daily basis for most open-end mutual funds. When you're purchasing a mutual fund, there are a number of different charges and fees that can be attached to the fund. So we'll go through 4 different types here. First off, we have something called a front-end load. And this means that when I purchase the fund, if there is a front-end load attached to it, I'm paying an additional fee to get into the fund. I pay that at the front end. So that's why we call it the front-end load. So if my net asset value per share is $10 and there's a front-end load, I'm going to pay a little more than $10 per unit to get into the fund. On the other hand, I could have, instead of a front-end load, I could have a back-end load, which means that when I purchased the fund, I didn't pay anything additional to get into it, but I will have to pay when I get out of it. And oftentimes we call this a declining sales charge because when you hold the fund for a longer period of time, you usually will pay a lower percentage fee to get out of the fund until such time that you've held it long enough that you won't pay any fee. So your charge is at the back end, and it's usually declining over time. In contrast to these two, the front and the back end load, you can also buy mutual funds for which there is no load, which means that you pay nothing to get into the fund other than the net asset value, and you have no additional sales charge to get out of the fund. Finally, we have something called the management fee. And this isn't the same as the other 3 types of charges. It's not a fee that you pay yourself per se out of your pocket. It's the fee that is paid to the fund manager for doing his or her job. So essentially what happens is it comes off of the top of the earnings of the fund and is paid to the fund manager. And then when returns on the fund are reported, they're reported after the management fee has been taken off. Now, with mutual funds or open-end funds, there are several different types, and the list that I have on the slide here is not an exhaustive list. There are others in addition to this, but this is a pretty good synopsis of the types of funds that you can purchase. Each of these types of funds invests in different types of securities and has a different objective objective. So different funds will suit the needs of different investors. So first off, we have money market funds, which in a nutshell are the lowest risk mutual funds, and they invest in money market securities. Then we have equity funds, which invest in stocks and have growth as their main objective. They tend to be higher risk. Bond funds invest in bonds. They may invest in only government bonds or a combination of government and corporate bonds, maybe only short term, maybe short and long term, just depends on the fund. Their main objective is the income provided from the bond, as well as the potential for some capital gain on the buying and selling of the bonds. Then you have balanced funds and asset allocation funds, and I deal with them together because they are very similar to one another. Both of these types of funds invest in all three of the asset classes. So both a balanced fund and an asset allocation fund will have a percentage of their investments in cash or cash equivalents, a percentage in income securities, and a percentage in growth securities. And the percentages can differ between different funds. It's up to the fund manager how they will allocate it. The difference between the asset allocation fund and the balanced fund is that with a balanced fund, the fund manager has a limitation. They have to have a minimum percentage of the fund in each of the asset classes at all times, and that's stated in the fund's objectives. So the fund manager cannot drop, say, the fixed income holdings below 25%, for instance. They can have more than that, but they can't have less. The difference with asset allocation funds is that they do not have such a limitation. So the fund manager of an asset allocation fund could, if they wanted to, put 100% of their money in growth stocks if they wanted to. They have no minimum amounts, whereas the balanced fund does. Then we have something called an indexed fund, and this is the type of fund that is not an actively managed fund. This fund is designed to track the movements of a specific index. So if we wanted to track the movements of the Toronto Stock Exchange and we wanted to invest in something that would give us the same return that the Toronto Stock Exchange is getting, then we would invest in a TSX index fund. And that just means that the fund holds exactly the same stocks that are in the TSX index, and they hold it in the same percentages. So whenever the index rises and falls, the value of your fund rises and falls. Next, we have something called a sector fund. And a sector fund is a fund that is considered to be a little bit more risky because there is not as much diversification in this type of fund. The investments in this fund are focused in one sector of the economy. So you might have just a financial services fund or just a metals and minerals fund. So because you're only focusing in one area or one industry, you don't have as much diversification, because if that one industry doesn't do well, then your fund won't do well. Finally, we have something called an ethical fund, and this is a fund whose investments are chosen based on some moral criteria. So you may have an ethical fund that states that it will not purchase the shares of tobacco companies or companies that manufacture small weapons. You might have ethical mutual funds that will only purchase securities in companies that are environmentally friendly, so things of that nature. Of all the different types of investments that we've dealt with and all the different mutual fund types that I just listed, each of them has a level of risk, and they go from the lowest to the highest risk. So what we tend to use, and in some cases, is a pyramid of this type that shows us that the lowest level of risk that we have is something that is in the cash equivalent stage, something that is liquid. It's not going to provide us with very much return, but it gives us that protection and that safety that we need as part of our portfolio. Every portfolio should have a portion in this protection area. And then you go up to the middle of the road, the low to middle risk, and you have income type securities that fall in that range. And then the higher risk level, and that's where you have your stocks and your derivatives. And within that frame, you can go from conservative to more risky, which would be speculative, and they're all growth-related investments, some more risky than others. So the more risky ones, the derivatives, would be near the top in the speculative area, whereas, say, a blue chip stock that's tried and true, has been around for a long time, always paid dividends, that would be in the conservative area. With mutual funds, we have a portfolio manager or a fund manager whose job it is to determine the day-to-day decisions that have to be made on the fund. The fund manager decides what investments are going to be held, how long they will be held, what industry you're going to invest in, when to sell things that are not performing well, all of those types of decisions. So the fund manager can be one person, or it can be a team of people. It can be someone who is employed by the fund company, or they can be hired externally from the fund company. And one of the things that they do in their job is to calculate that net asset value per share. And as I said before, most of the time that's calculated on a daily basis. There are some funds for which the net asset value per share is calculated only on a monthly basis. Another one of the big jobs for this fund manager is to prepare the prospectus on the fund, which is the document that outlines all of the pertinent details of the fund for a potential investor. Now, previously we talked about some of the fees that can be paid when you're purchasing or redeeming a mutual fund, and we talked about the management fee that the fund manager receives for doing his or her job. But in addition to the management fee, you also have some additional expenses that the fund will incur: brokerage fees, legal fees, marketing, advertising, auditing, all of these things that are part of the everyday running of the business. So in order for an investor to be aware of how much of the fund's money is being spent on these expenses, a calculation is done called the management expense ratio. And it basically just takes all of the expenses of running the fund, which includes the management fee and all of these other things, and it presents it as a percentage of the net asset value of the fund, the assets minus liabilities of the fund. So something with a high management expense ratio means that a fair amount of the money that's made by the fund is being used in the day-to-day running of the fund itself as a business. Something that has a low management expense ratio means that they're being very effective with their use of the money that they generate within the fund. This isn't to say that you would never invest in a fund that has a high management expense ratio. You would just want to ensure that the returns that are being generated by that fund are high enough that they can compensate for the high management expense ratio. So here on this slide, I just have the management expense ratio calculation. So it's just the total aggregate fees for the fund throughout the year, which includes the management fee, and divided by the average net asset value for the fund for the year. So they look at what the net asset value of the fund was at the beginning of the year and the end, and they average it. Now, we've talked before about the rate of return calculation, and I mentioned to you that anytime we calculate a rate of return on an investment, we simply take the amount of money that we made and divide it by what we invested to make it, and there's nothing different here. So when we're dealing with a mutual fund, we have two potential sources of earnings. We can sell the mutual fund for more than we bought it for. That would be our capital gain. And then I said that mutual funds pay distributions throughout the year, so that would be the income that we would derive from the fund. Whether we've reinvested it or not, it's money that we've been paid. So in order to calculate on an annual basis, or for any period of time for that matter, what your rate of return is for your investment in a mutual fund, you simply take the ending net asset value per share divided by the beginning net asset value per share plus your income per share, and divide by the beginning net asset value per share because that's what you paid for it. So I have a quick example for you here. Beth invests in a mutual fund at $20 per unit net asset value per share. Throughout the year there's an income distribution of 15 cents and a capital gain distribution of 5 cents. And at the end of the year the net asset value per share is $20.10. What has Beth's rate of return been on this investment? So it's currently worth $20.10 minus the $20 that was originally invested, so that's your potential capital gain. And during the year, 2 different distributions were made for a total of 20 cents, and we divide that all by what she invested, the $20. So she has a rate of return of 1.5%. Now the final slide is just a definition slide, really, some terminology that you will find on mutual fund statements that I want you to be aware of, and that's the difference between the market value of the investment and the book value of the investment. So when we refer to investment funds, the market value is the value of the investment today. The book value is what you originally paid for it.